Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
This particular print is not helpful, but if what I expect for the next couple of months does continue to play out with more modest inflation, and again, no details here really suggested that that view is wrong. I do think that it leaves them in a position where they can respond to the potential impact of uncertainty on the labor market later on this year. I'm still expecting that they're going to cut by mid-year and probably have 3 rate cuts in June, July, and September.
I do think that we are in for a more chaotic implementation of these tariffs. Canada has already, in a staggering speech that Mark Carney gave yesterday, really, almost divorcing from the United States. I think we can't underestimate that Canada is one of our key trading partners, and they will retaliate.
Q4 we knew was very good internationally. They had already pre-announced Q4 positively, and their gross margin was even up above where we thought it would be, at an all-time high of 60%. I think the stock's reaction today is more in line, is in reaction to the implied guidance for U.S. comps, which is clearly negative as we go into Q1. So they've got to get that America's business turned around and comping positively.
We got 1 hour to go until the market close. So let's take a look at the major averages. We have a sell-off today that has been accelerating even throughout the day here. That's as we have a couple of things going on. We had PCE data this morning that came in a little hot, inflation a little hotter last month than people were wanting to see. And then, of course, there is still the looming tariffs that are coming next week. And there's still a lot of instability, it seems like. People are a little off balance ahead of those, I would say. Yeah. The Dow right now is down more than 700 points, 1.7%. The S&P down 1.9%, and the Nasdaq down 2.7%.
I think it is just the 1-2 punch you just outlined, Julie. I think you got economic data this morning, and to your point, economists said, that's kind of sluggish spending growth, which was, that's sort of like, is that more evidence of this cautious consumer, which would mirror the consumer sentiment data we've been getting, which has not been great. Right. Then to your point, also inflation, signs that maybe that's kind of sticky here. And to your point, all of that against this backdrop, we're all waiting for next week. We've had April 2nd on the calendars for a long time. That's when we think the White House is going to announce these new reciprocal tariffs. But what exactly is Trump going to say? What is he actually going to spell out? Do we actually get any hard details? It's all this uncertainty, so it's not that surprising. I think you add it up, and people just don't want to step in front of that.
Yeah, and meanwhile, one thing to note about that PCE data that we got this morning is it was before the tariffs really started to take hold. So if you're already seeing inflation not come down, maybe even heat up a little further before you even get the impacts of the tariffs, which any economist you talk to will say that's going to be at least cause a temporary increase in prices. Not great. So interesting that we're seeing yields come down even with that inflation number going up a little bit, 4.25%. Maybe people going into treasuries looking for a place where they feel safer. Do you think that's
also, because it's a very good point you're bringing up, is that also maybe telling you, hey, I'm the market, what I'm really worried about is growth?
Yes, that could indeed be, and you see that in gold, by the way, too.
Yeah, look
Speaking
at that.
of Haven, above $3,100 an ounce. Getting back at digging into stocks here, what's also interesting is where we're seeing the risk off happen, and it's happening in growth. Maybe to your point about these concerns over growth, what is this going to mean for the Magnificent Seven? Nothing good, judging from all the dark red that we are seeing on this screen here today, with a big declines really across the board.
All right, let's get more perspective on this. On today's sell-off on Wall Street as it grapples with President Trump's escalating trade war. Let's now welcome in Linda Dissel, Federated Hermes Senior Equity Strategist. Linda, it is great to see you. We turn to you, Linda, on this day for some insight here. How do you make sense of the action we're seeing here, Linda? Is this the economic data we got? Is it trade? Is it tariffs? Is it April 2nd next week? How do you make sense of it, Linda? Is it all of the above?
Well, first of all, thank you very much for having me. Good afternoon to both of you today. I don't like to come in on a bad day like this, but there are cross currents. I think, as you are suggesting, we came into this year very strong, and it's funny because why is the stock market going down? Because we have lots of uncertainty. now. And that's one thing the market absolutely hates. Now, the consumer is feeling very negatively inclined. He's still been shopping, though, interestingly, and he still, for the most part, has a job. So that's, very important. And that is after, you saw the consumer confidence absolutely plummet, the worst on record. Well, you want to know something? In the fourth quarter of last year, it rose to the highest, that is to say, for the next 12 months expectation on stock returns, the highest it had ever been. After two 20+% year back-to-back returns, you had a lot of momentum, and we deserve to unwind that. And I think that's a big part of what's going on, is the unwind of the momentum.
What about all the underlying stuff, though, Linda? What about the tariffs? What about the fact that inflation is not decelerating here? How much of, in other words, what you're talking about implies that it's not real, for lack of a better word. There aren't the fundamental sort of underpinnings to the sell-off that we're seeing. Are you worried about any of those fundamentals?
Yeah, of course we're worried about it. And I do also want to emphasize that retail net selling has been, I think, only 7 days of net selling, at least up until this week, year to date. We're having angst and we're not doing anything about it. And if we really are feeling negatively inclined, we should at least have a decent 10 or 12% correction. We'll get more bullish on the market at Federated Hermes at S&P 5400. But yes, we're worried about fundamentals, sure. And we at Federated Hermes are more worried about the unemployment figures rising than we were inflation. We figured that structural inflation would not go back down to where it was, the Goldilocks 2%. Now we're probably up in around the mid to high 2%. And we still can get there by the end of this year. So there's a lot of cross currents in advance of April 2nd. That includes a lot of buying in advance. So maybe durable goods numbers are better than we expected. Maybe that's front running. Maybe there's pricing involved in that. All these cross currents, we simply need to settle down. If we can believe after April 2nd, we've got a lot less uncertainty. And even that's a question, isn't it, today?
It sure is, Linda. What is gold telling you here, Linda, do you think? What message is the metal sending to investors as it rises to a record?
Yeah, it's risen to a record. And when I see that, of course, not saying that we don't like gold at all per se, but so many other things have been at a record, and welcome to the record area, gold. But the kind of the attitude towards gold is at the highest that it has been for the last 10 years. It's in the 100th percentile, which, is actually the opposite for the more bullish areas of the markets, like plummeting versus rising. What am I supposed to do in a period of uncertainty? Maybe I should run to gold then, or maybe I should run to treasuries then. We acknowledge it's a period of uncertainty, but we could be getting maximum uncertainty if we don't see unemployment rise, and fairly dramatically. Knock on wood, not yet. And we'll wait and see next week's figures on the payroll.
And so, Linda, what are you telling clients amidst all of this? What are you guys doing in terms of your risk appetite or lack thereof in portfolios? So,
we have a very unconventional president here. He said he'd be predictable. He's being unpredictable, just as you said. Canada said, we're going to come back right at you. This is going to be a news-filled presidency. That being the case, who knows what the next months hold? And so if you don't know and you're willing to say that, then you won't make any major bets. So we're basically diversifying in terms of where we would invest. No particularly big bets we're making, but we do expect that a Trump presidency will see a higher yield curve. He promised lower regulations. For the banks, love that. Financials in general love that. They love that in his first presidency. So financials still looking expensive to us. We like that. The energy patch is as cheap as any sector in the S&P, and we like that. And the big ones too, very, very strong companies. And as you brought up at the start of this segment, they've absolutely crushed these big tech names. It's not as if the big tech names aren't doing well. It's that we were all crowded in them, and they're not nearly as expensive as they were at the end of the year. So knock on wood or whatever's nearby, we don't get a recession this year. We could potentially have a buying opportunity set up. Meantime, we're diversifying.
So, Linda, financials and energy, where don't you see the opportunity, though? Are there sectors where you say, hey, that just doesn't look as attractive to me here?
Well, in general, we would say this is not an early cycle time. And I mean, I acknowledge that financials are an early cycle play. Consumer discretionary is a typical very early cycle play. And so you might, steer clear of that. We're in general, we like value, in particular value very much. That includes both defensive value and cyclical value, but we may hold back on that cyclical value for the moment here as we wonder if earnings are going to slow down. Have liked it, maybe pull back on that a little bit, and if we're going into tech, which we do like tech, particularly on a pullback, we want to make sure we're buying high quality tech and not the big swath of it. It's truly more of a stock picker situation, as I said, diversified and quality.
Linda, thanks so much for your time. Appreciate it.
Thank you both very much.
We're just getting started here on Market Domination. Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. And in the 4 p.m. hour, we're checking in with a local car dealership to get a sense of the impact that auto tariffs could have. Stick around, more Market Domination still to come.
Soda stocks are slipping today. This is coming after Robert Kennedy Jr. reportedly announced his intent to seek the federal government's help in banning the use of food stamps to buy soda. This is according to the Washington Post. And just reading through the Post report here, Julie. So RFK Jr. pushes this ban on soda being purchased with food stamps. They say he appeared in West Virginia where the governor announced he would seek the federal government's help to bar soda purchases using food stamps. Not surprisingly, it does not sound like the beverage industry is all for this. I do see somebody from the American Beverage Association telling the Post, saying here, what's unhelpful about this whole conversation is that soda is not driving obesity. We've become this easy punching bag, they say.
I mean, it's not great for you. I think we can all agree that soda is not fantastic for one's health. Nonetheless, it seems like the process here is what merits some attention. So the states get SNAP authorization from the federal government. It sounds like, according to the Washington Post, that actually goes through the Department of Agriculture, which is not under RFK Jr.'s purview.
Under Brooke Rollins.
Right, exactly. So the states would have to apply for a waiver to say you can use your SNAP dollars, your food stamp dollars, but you can't apply it to these types of beverages. So we'll see if they actually make this. We'll see if her department approves it. Now,
Secretary
in other words, they're talking about it. Will actually something happen? We'll see.
Secretary Brooke Rollins, Department of Agriculture, did say here in a statement, it sounds like, I look forward to receiving Governor Morrissey's SNAP pilot request and will work swiftly to make certain West Virginia is equipped with the technical assistance and expertise to move forward.
Yeah,
we'll see what happens.
Well, fears of President Trump's escalating trade war and signs of reinvigorated inflation pressure sending markets into a spiral. Yet on Capitol Hill, lawmakers hoping the certainty of an April 2nd announcement on tariffs will alleviate consumer anxiety. Here with more, Aveda Partners co-founder and director of economic policy, Henrietta Trays. Henrietta, I suggest you have a bridge you'd like to sell people if they think that certainty is coming on April 2nd. I know you've been watching this really closely. You've been talking to so many people in Washington. What are we going to learn on April 2nd, and what happens then?
I think on April 2nd, well, really April 1st, when we see the release from USTR Greer and the Commerce Secretary and the Treasury Secretary about every single piece of the trade landscape that President Trump intends to delve into for the next 4 years. What I'm most concerned about, obviously, is the tariffs that are going to be implemented day of. I think that's going to be things like tariffs on automobiles, specifically with the European Union. I'm very concerned about the broad scope that was proposed in his executive order last night. I also think that we're going to see some determinations that China is in violation of their phase 1 trade agreement. So tariffs across the Section 301 list could all rise from their 25% and 7.5% rates. But I think what's going to be really pernicious is the announcement about new investigations. Because as we know, once you provide the backbone of the rationale for tariffs, like a Section 301 investigation into China, those tariffs are sticky and they only get higher. The China tariffs have been in place now for 7 years across 2 administrations. So I think the market is going to have a lot to digest, and they're going to see just how forward-looking and long-term these tariffs are, which is not currently priced in.
Henrietta, we know Trump loves tariffs, of course. I'm just curious, when you're on Capitol Hill and you're talking to Republican lawmakers right now about tariffs, what are they telling you?
They're telling me that they think that the tariffs are impacting the market only because they're uncertain. And as soon as we have clarity, it's 80-20, 80% of the market reaction, and today's 700-point decline is because of the uncertainty generated by tariffs, not the economic impact of tariffs. There's another view that the tariffs are really not going to be on for that long. But the staff is almost talking to you like they're hopeful, but there's not a pathway for them to really go to USTA and USTR and say, hey, I need an exclusion. And so when you talk to trade associations, they're very concerned because they are already tariffed, and they don't have a pathway to prove either that they're USMCA compliant, to guarantee that their provision shouldn't be tariffed at the border. And there's just a lot of confusion. So Republican staff is, I think, really pushing this to the side as the president takes his decisions unilaterally.
So many market participants we've spoken with, Henrietta, still say they see tariffs and President Trump's use of tariffs as a negotiating tool. Do you still think that, or maybe you never did, do you think that's the case? Do you think that's the wrong way to frame this?
There are 20% tariffs on $489 billion worth of goods coming in from China, on top of the 25% tariffs that he imposed 7 years ago. No, this is not a negotiation. And let's maybe take it a little bit further. If you do enter into negotiations with other nations, those negotiations take years. We reached a phase 1 trade deal with China in 2020, and there is still no adherence. After the tariffs go into effect, you don't just need the countries, say the EU, to come into the room with you and begin negotiations. You need to reach the end of the negotiation and then have them prove that they've delivered on whatever it is that you've asked them to do. That takes a tremendous amount of time. I think the EU auto tariffs, for example, are going to be in effect for a minimum of 6 months. 12 months is entirely possible. And should we run into different issues on the digital services tax or agriculture trade, it'll just continue to expand.
Henrietta, I had a political question for you as well, which is that, you think about Trump's GOP, Henrietta, it's a different kind of GOP, it's a different kind of coalition. He's brought in more, it's blue-collar Americans and working-class Americans. To the extent that you see these tariffs and they raise prices for these folks, how loyal do you think they remain to Trump, and for how long?
There's some really interesting polling data about all of the president's agenda, the immigration issues, deportations, even the tax bill and tariffs. And tariffs consistently rank as the lowest area of support amongst his voters. So while they are behind him and 83% of the population thinks that China is a major threat to the United States, we are not unclear about the fact that tariffs are taxes. The American public knows that. So when President Trump comes out and says this is Liberation Day and, tariffs are a tax cut, you can see from the consumer data that is coming out right now that the American public is not buying what he's selling on this specific topic. So I do think it's an interesting area of disconnect. And on Tuesday, the Democratic conference in the United States Senate is actually going to force a vote. They just announced this about an hour ago. They're going to force a vote on the IEEPA tariffs against Canada and get all the Republican senators on the record either supporting or opposing the IEEPA tariffs that Trump has put on at 25% rates against Canada. And that's going to be fascinating. That'll happen on Tuesday.
So, Henrietta, the other thing that's been fascinating about this Trump term versus the last Trump term is even when there were things like tariffs, he would also try to present other things that his constituents would be happier about, a tax cut, for example. Right now, you got the tariffs, you got chest beating about Greenland, which I don't think a lot of voters are super excited about, I think safe to say. And where is the good news? Where is the stuff that we're transitioning to? Where are the maybe tax cut extension? How are you thinking about how the administration is approaching these questions and whether they care, how they're thinking about them?
I think that's a really critical question. So we talk a lot about the tax bill that Congress is writing right now. It's a minimum of $5 trillion, all of which will be deficit financed. And they're not passing a tax cut to help the consumer weather the soaring egg prices or the potential for tariffs on lumber, which will drive home building costs up even higher, or the new tariffs on back to school items like a backpack or a bicycle. It's literally everything that's being tariffed. And so you're looking for some sort of relief. You were mentioning Brooke Rollins before, the USDA secretary. They're already talking about providing a bailout for farmers in anticipation of something we haven't even talked about, which is the retaliatory tariffs that other nations are going to put on us. So it's not just that the tariffs are passed on to U.S. consumers when they're collected coming into the U.S. It's also that all the goods that we are exporting are going to be tariffed and have a problem leaving the country. So those farmers or any manufacturers trying to ship things overseas are going to see either boycotts like we've seen in Canada or higher tariff rates as we've seen in Europe and China. And those are real pernicious problems. And there are no tax cuts in the bill that they're writing right now.
Henrietta, do you think ultimately the possibilities here, would we just extend the expiring tax cuts, or do you think that we'd also see new tax cuts?
We are working on extending the existing tax rates. I do not expect any material reduction in individual tax rates whatsoever. At the best, what we can hope for is a fix to the SALT cap. I think that has to happen for members like Mike Lawler in New York who have ambitions for statewide office. There's going to be have to fix there. Of course, that only benefits a certain segment of the population. It disproportionately skews to the wealthy. We do also want to extend a child tax credit. But again, it's just an extension of the status quo. The reality is the 2017 tax cuts were too expensive to make permanent, and therefore they expire. So the alternative, and what is happening right now, is we either raise taxes through inaction, or we act and it's so expensive that all we can really do is keep things where they are, flat. So you have increased tariffs, which are taxes, and no commensurate tax cuts, just an extension of the status quo.
Henrietta, I hope you're getting lots of rest, doing good stuff for yourself this weekend, because boy, you're going to be busy next week.
Yeah, it's going to be a lot. I'm excited.
Yeah, as are we all. Thank you.
Yeah.
Appreciate your time. Now time for some trending tickers. Let's start with AppLovin. Those shares are bouncing back today following a fall of 20% on Thursday. That drop coming after a report from short seller Muddy Waters Research that it had taken a short position in the stock. AppLovin now says it has hired a law firm to investigate short seller activity, and the company's CEO is urging investors to, quote, dig deeper given the AI tools available today, and that it's, quote, easy to discredit a short report like this in minutes. This coming in part from a blog posting by the CEO, because one of the things that these short reports, and by the way, Muddy Waters was just the latest in a series of them that has talked about that the company's measurements of its own ad metrics are not accurate. That's what has been called into question. AppLovin has come out and defended them.
Yeah, this is one of those names too, Julie. We talked about. He had just a monster run in 2024. Huge move. But the short sellers have been out. The street, what's interesting, has really stuck with this name.
Yeah.
I mean, the analysts who cover the name are overwhelmingly bullish still. The CEO did say in a statement, I see it at Bloomberg, we will take all necessary steps to ensure the facts are known, protect our employees, stockholders, and partners.
Yeah, and Loop, by the way, to your point about analysts, Loop would be aggressive buyers on weakness here with a significant expansion cycle underway.
They like it. They are fans. All right, moving on. Wolfspeed shares, they're sinking today as the semiconductor maker is struggling to reach a deal with investors to refinance its $575 million convertible bonds due next year. So that does seem to be the issue here. Bloomberg citing sources saying it is struggling to reach this deal with investors to refinance $575 million of convertible bonds due next year. It's been working with JP Morgan on the refinancing effort. Company saying in a statement, Wolfspeed continues to explore alternatives with regard to its convertible notes. In partnership, it says, with advisors, remains in dialogue with lenders.
Yeah, this is a company that makes silicon carbide wafers, and chips are built on those wafers. The company had signed a deal with the Commerce Department as part of the CHIPS Act to get some financing for a project to build out some production. The future of that is uncertain, as is the future of the CHIPS Act more broadly. So that's something to keep an eye on as well for this company. But obviously, just a really dramatic decline and concerns, it seems, about future financing.
Down more than 90% now over the past 12 months.
Amazing.
Just shelled.
Well, speaking of declines, let's take another look at what's going on in the markets here. We're just about a half hour away from the closing bell, and we continue to see selling across the board here. All major averages hovering near the lows of the session. Right now, the Dow is off 721 points. The S&P 500 down 2%, and the Nasdaq, the big loser of the day, as we see large cap tech really lead those losses. It's down by 2.7%. Seems pretty clear that traders do not want to be long into the weekend.
Coming up, it is the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive. 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. Today we're taking a look at players in the healthcare sector. I'm here with Skylar Wynan. He's Reagan Capital Chief Investment Officer. Thanks for being here. It's good to see you.
Thank you.
So let's take a look at United Healthcare, which is the stock that you like. Obviously, there has been a lot of drama, some of it quite tragic, that has involved this company. And even though the stock price looks like this, the stock's actually up over the past 12 months. I admit I was surprised to see that when I looked it up. So talk to us about why you like it. First of all, with that sort of round trip it's taken, you like the valuation of the stock here.
Yeah, first of all, healthcare is one of those sectors that's actually done fairly well this year. And so I took healthcare and I broke it down between, what's trading cheap and what's trading rich. And United Healthcare, for a variety of reasons, is trading fairly cheaply in the healthcare sector. So at about a 20 PE, I think it's fairly attractive.
So let's talk about sort of the elephant in the room here. Obviously, there was the murder of an executive at the firm, but there's also sort of concerns about what the healthcare landscape is going to look like. But you don't think that this is going to cause permanent issues for the stock and for the company?
Yeah, when you look at America, aging, demographics, there are a lot more folks that are retiring every day than that are being born. So generally speaking, we're going to need healthcare, and Medicare, Medicaid, those are going to be huge pieces of that healthcare puzzle. So United Healthcare sits in a really interesting spot. Yeah, there's some lawsuits. Yes, one of their executives was shot not too long ago. And I think those have been kind of buying opportunities. And you're looking at a stock that's done fairly well over the last year. Healthcare has done great this year as a defensive type of sector. And just demographics alone, let's get in healthcare. Let's get in a name, one of the biggest in the business, United Healthcare, at an attractive PE ratio.
And a company that has seen this sort of consistent growth over time because of that expansion and the need for healthcare that you're talking about.
Oh yeah, 11+% over the last 10-year compound CAGR. And so, I just think about the demographics as a whole, and it's why folks are gravitating towards healthcare, towards defense, some of the more defensive sectors out there. It's a no-brainer. And so use this opportunity, use these news events as opportunities to get into a name like United Healthcare.
So let's talk about what could be a risk for the stock going forward. And that's, could there be some kind of reform to spending, to insurance spending, to Medicaid? I mean, we're already seeing some hints of that happening.
That is the elephant in the room, right? The current administration looking at programs, looking at overspending in Medicare, Medicaid, and thinking about, we're just going to fire 10% of the staff, or we're going to get rid of, we're only going to pay out 90% of expenditures. And obviously that's going to hit a firm like United Healthcare, 400,000 employees. A lot of those employees could be on the chopping block if, let's say, the administration were to say, we're just going to cut payouts by 10%, which isn't out of the question.
Right. Yeah. All right. Well, that's something definitely to watch. But let's talk about the stock you don't like, which is Eli Lilly. This stock also, again, I was a little surprised to see its performance is pretty much similar to what we've seen from United Healthcare. Yeah. It's had a big run too, and then come down because of its obesity medication. So flip side of United Health, it's got a higher valuation.
Yeah, you're looking at
peers.
Around a 50 PE. United Healthcare is at 20. They performed very similarly over the last year. And so it's really just, when you look at that S&P Healthcare Index, I think this is the highest PE. These are two of the largest market caps in that sector. So can they sustain this growth that they've seen, does it really justify a tech-like ratio? I don't think so, because it's so reliant on new drugs coming out and the FDA approving those drugs. It's really hard to repeat that process over and over again.
Well, GLP-1s, which have been a big boost to them, that's been part of the big story here that has pushed up that revenue, right? That has been one of the triggers for that revenue growth. And even though there is expected still continuing adoption, you just don't think we're going to see the same kind of magnitude of percentage increases going forward.
Yeah, when you look at these two stocks and the amount of cash UNH is generating versus Lilly, it's like 5-6x earnings, okay? And so trading at a 50 plus PE, being reliant on the next drug to be as successful as the last one, you're walking a very fine line there, right? What should this trade at? I don't know. It should trade at 30, 35 PE. And obviously United Health is a little bit slower of a grower.
Right.
It doesn't have as many pops as this, but year-over-year performance will look very similar types of stocks.
Yeah, that's what I was saying with the 12-month. It is surprising. And as you mentioned, mainly reliant on drug approval success and sales, sort of feeding the pipeline beast, if you will. Yeah. Let's talk about what could go right, though, for Eli Lilly here. You could see more FDA approvals. I'm going to let you say the name of that drug instead of me. What is this drug, first of all, and what could that do for Lilly?
Yeah, muvalaplin is a heart disease drug. They just had an approval, I think phase 2 approval in November. Very, very successful results for, one of the biggest killers out there in America is heart disease, and tons of Americans as early as 30 years old these days are going on heart medication, both statins and something like muvalaplin, which it's not going to eliminate plaque, or it's not a blocker per se, but it is bringing down blood pressure and relieving heart disease. So you're talking about this gigantic problem that they're solving, phase 2 approval, and there's still some time to go, but these are huge generational types of approvals that could go through. If that happens, okay, let's stay at the 50 PE.
Right.
But you're taking a huge bet on that continuing to happen.
Gotcha. Do you have positions in United Health or Eli Lilly?
I do not.
Okay, good to know. Skylar, thank you so much for being here. Good to see you. Thanks. And thank you for watching. Goodbye or goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
CoreWeave opening today on the Nasdaq at $39 per share. The lower than expected pricing potentially signaling investor concern about the sustainability of that AI boom. For more, we're bringing in now James Chuckmuck, Chief Investment Officer at Clockwise Capital. James, it is good to see you. So let's talk about CoreWeave, James. The big debut today. I'm curious, James, what you think the debut and the reception to that public debut perhaps tells investors more broadly about that AI infrastructure trend in space.
Yeah, thanks for having me. I think it leaves a lot to be desired. We were following it earlier this week and got some of the subscription numbers early on, and it was underwhelming, to say the least. You would likely see something like this 10x oversubscribed a couple of days ahead of the IPO, and it was about a third of that, and obviously not a good sign for the tech appetite for tech more broadly. And then you see that underscored with the pricing last night for it. So a lot of question marks out there, and right now, as we see it, there's a lot more uncertainty than not. So we think 50-50 market at best, with likely a bias continued downward, absent some type of tweet or whatnot that puts a lot of these concerns outside of the scope.
James, my only follow-up question for you on CoreWeave, though, the more you kind of read about it, it does seem to be it's a different kind of name and business, James. It's unusual in some respects. Per Bloomberg, more than 3/4 of its 2024 revenue was generated by businesses with its two biggest customers. One is Microsoft. Right. I mean, it's high concentration there. I'm just wondering, it does sound sort of unusual as a name, as a business. And I'm wondering if there's any risks in trying to sort of extrapolate from this name to something broader.
Yeah, obviously it does have high concentration with its customer base. That level of concentration is not something that you see regularly. Certainly it's something to consider. But at the end of the day, they're still part of an ecosystem that's growing in a massive way, and likely has secular tailwinds that are going to last years from now. So, in a normal environment, I think that despite the concentration risk, there would be appetite for a name like this. But right now, there's just too much uncertainty around what are the sustainable growth rates of these AI names, these AI infrastructure names, semiconductor names. Obviously, CoreWeave fits right central to all of that because their demand for their services is going to be lockstep for the demand for the ecosystem as a whole. So I think it just speaks to the broader uncertainty around the growth rates of the space versus anything specific to CoreWeave.
So that being said, James, it's Julie here. It's good to see you. So that being said, do you as an investor sit back and watch as we see the broader universe of AI-related names sell off, the large cap tech, et cetera? Or are you stepping in, maybe CoreWeave is a little too far out the risk spectrum within AI, but are you still getting into or adding on to other names within the universe?
Yeah, actually, we've been taking off risk for the last couple of weeks now. We still like the AI space. We're not going to be involved in CoreWeave anytime soon. But the way we look at it is you got to take a barbell approach right now. On the one side of the spectrum, you got to have your super defensive names, your commodities, your utilities, and whatnot. And for every dollar of that, we have something on the other side of the barbell, whether it be crypto, AI, semiconductors. So we're playing both sides. We see risk to the market for everything that's essentially in the middle, where you have earnings risk and multiple contraction risk. But we just don't know when the turn is. So you have to be involved, but just take a more defensive posture to the portfolio by balancing anything with excess beta with low beta, and adding hedges and raising cash where you can, and by selling into strength.
Sticking with AI, James, what did you make about these comments we got this week from Alibaba Chairman Joe Tsai? That got a lot of attention, and for good reason, James, warning of this possible bubble in the AI data center build out. And he said, I start to see the beginning of some kind of bubble. He said, I start to get worried when people are building data centers on spec. What was your response to those comments?
I took it as slightly hyperbolic. I don't really see a bubble in this space. There are questions around the growth rates of the companies providing the services to build out the infrastructure. But a lot of those estimates have come in. It's really now a question of risk appetite and the multiples that would be applied to these companies. So I think that the infrastructure needs to be built. There's tremendous demand for these services. I think the productivity boom you're going to see coming out of AI is going to be eclipse a lot of people's expectations. That old adage that people tend to overestimate changes over 2 years and underestimate the changes over 10. I think that's as pronounced as can ever be today. So I don't really buy that much into the commentary around it being a bubble. It's more so, what are the sustainable growth rates and what are investors willing to pay for it? And right now we're just in choppy waters and just got to navigate the volatility.
So James, where are you guys adding? Where are you looking here that feels more defensive? Is that within tech? Is it elsewhere entirely?
Yeah, like I said, on the one side of the barbell, on the defensive side, commodities like gold, utilities, we think in healthcare names, I think will be safe havens. And on the other side, we're incredibly bullish on crypto. And I don't think you can overlook that. I think that's going to be a big major winner for 2025. So we're leaning into there. We like some of the AI trades. We're much smaller in NVIDIA, but we're still there. We're looking at the AI power companies like Oklo, I think, in small size, but I think that there's opportunities there. So really, it's just about taking a balanced approach. But right now, you got to play defense. Too many unknowns, and until we're on the other side of this, the good news is that a lot of this pain and volatility stems from the fact that it's self-inflicted. What we're setting at the administration setting, kind of the tone and tenure of the negotiations around tariffs and whatnot. And really, all we need to do is see what type of cycle are we going to have? Because anytime you say, okay, we're on the next leg up, we're on the next leg down, it lasts 2 days. You can't make a definitive call on what the next 2 weeks looks like, much less the next quarter. So really taking very short-term time frames on things and capturing gains where we can, but also not losing sight of the fact that things can turn very quickly because it is self-inflicted, so maintaining exposure, but just being a lot more tactical and precision-based. That's what you got to be in this market.
Yeah. James, good to see you. Thanks for joining us.
Thank you.
Coming up, we're taking a look at the best ways to be positioned within the banking sector with today's Investor Playbook. Stick around, more market domination still to come. It's that time again. Bank earnings are right around the corner. With a higher for longer rate environment and an uncertain IPO market, we're navigating how to play the banking sector with the Yahoo Finance Playbook. Joining us now is Jason Goldberg, Senior Equity Analyst at Barclays. Jason, it's always good to catch up with you. And I guess we have to start with the macro environment here, right? And the decline we're seeing in stocks today, the concerns over consumer spending, amidst a still higher rate environment, what are the implications for the banks broadly from all of that?
Yeah, no, certainly. A lot of uncertainty in the markets right now, whether it's tariffs or tax or immigration, geopolitical, and whatnot. And you're certainly seeing that cause a fair amount of uncertainty among corporates. So loan growth continues to be subdued. And investment banking activity, both M&A and IPOs, which I think were thought of to kind of benefit from this pro-growth, less regulatory agenda from the new administration, has kind of been at least pushed out for now. On the flip side, though, trading activity has actually been fairly active. So volumes, volatility have benefited from. So while, for the biggest banks at least, while maybe loan growth and investment banking fees a bit more subdued than anticipated, on the other side, trading activity continues to be fairly active.
Jason, I'm just looking at the XLF. It's basically flat this year. I'm just curious, broadly how valuations look across your coverage universe.
No, looking out, valuations, I think, continue to be attractive. You're at about 2 multiple point discount on a PE basis, historical averages, price to tangible book basis, a little bit below historical averages. And if we can get through some of these uncertainties, things like loan growth and investment banking fees, should come back. I think just corporates are hesitant at the moment. Maybe next week we'll get some clarity on tariffs. Looking out, there's hope for some tax reform. And as corporates kind of figure out, the game they're playing, they could, adapt and invest in their businesses.
And so, Jason, how does that imply your feelings about some of these big money center banks that also have big, robust investment banking operations versus, say, the regional banks?
Yeah, I would say, at the moment, maybe a bit biased towards, the bigger banks because they do have the benefit of, the trading activity. And another consideration is, we do think, once this administration kind of figure out tariffs, they're going to, the next thing to focus on is deregulation. And it's true we think for all industries, particularly for banks. After kind of 15 consecutive years now of increasing capital requirements and other regulatory obligations, there is an ability to take a more pragmatic approach and a holistic approach to some of those things. And we think as that becomes clearer, the biggest banks, which were most adversely impacted, have a lot to gain there.
Jason, you mentioned IPOs a second ago. Obviously CoreWeave making its public debut today. I'm just curious to get your thoughts on the IPO market 2025, Jason, whether you're optimistic or skeptical, and to the extent that you are optimistic, which names that you cover are sort of best positioned to capitalize?
Yeah, certainly coming into the year, if you look at IPO pipelines, were fairly robust, both, from in part driven by sponsors as well as companies just looking to, go public. And, while maybe, the first quarter got off to a little bit slower start than anticipated, we think once the market kind of figures out what's going on with respect to some of these macro issues, there's still room for a fair amount of activity to pick up. In our coverage, Goldman Sachs and Morgan Stanley are probably most geared for that. And it's certainly something that we're watching closely.
So would you say they're your favorites going into earnings? Where do you think investors should be looking?
Yeah, I think, earnings are certainly kind of always, a bit choppy, and we think this quarter will be no different. At the onset, you talked about maybe softening consumer spending. Some of the sentiment indices have, shown some signs of degradation, and quite frankly, the outlook for the economy, whether it's GDP growth or unemployment, has deteriorated somewhat. So you have to be mindful of what, loan loss provisions will ultimately look like. But, looking out over the course of the year, the bigger banks, whether it's Bank of America, JP Morgan, Citigroup, we talked about Goldman Sachs, Morgan Stanley, we do think could do well, with, probably momentum picking up in the back half of the year.
Jason, I'm just looking. I see only two underweights, my friend, in your coverage universe. I see Zions Bancorp and Regions Financial. Why are you telling clients those are sells?
Yeah, we have a couple in there. Just listen, I think in current environment, we're paying a bit more attention, to credit quality. And if you look at a name like Zions, has had the sharpest increase in the last 2 quarters with respect to criticized classified loans. So that's something we're keeping an eye on. Regions, they tend to have, if you kind of look at their customer base, they're more focused on the lower end consumer. And if you think about, the current landscape, elevated inflation, still high interest rates, they're going to be most adversely impacted there. And then Comerica is kind of the most exposed bank we covered is C&I lending, which is an area that, has been, under pressure the last several quarters. And if you kind of look at data so far this first quarter, it continues to be subdued. So kind of just some idiosyncratic things we're keeping an eye on.
Jason, always great to see you. Appreciate your time and those picks.
My pleasure. Have a good weekend.
You too. Let's do a quick check of the markets as we're wrapping up today's market domination here. We've got a lot of red on the screen here, Julia. I'm looking at the Dow. We're down about 670. The S&P down about 1.9%. Your tech-heavy Nasdaq, that's actually leading the way lower, down about 2.6% here. Don't go anywhere. We've got you covered. All the action following the closing bell. Stay tuned for market domination overtime.